welcome everyone. Very nice to see you again for the second time this week. I guess no long intros needed. We're very much known now for the fourth time already. But getting into for today's session, we have again it's into two parts. We have a guest from Lithuania, Andra, representing First Pick Ventures, who's going to talk about Baltic market data, investment agreements, and typical mistakes in term sheets and other type of legal limbo. And then we have Jans representing Sorainen, who's going to be taking you through the exit routes and what you need to kind of understand and think about when investing in a startup and kind of thinking ahead 5 years and trying to predict your, let's say, positive outcome. But I guess without further ado, I can give the floor to Andra, and I guess you can introduce yourself much more better than that me.
So I'll try to make this as entertaining as possible, although the topic itself is quite technical, right? Because we will be speaking about investment agreements and how they are different and what are some of the main clauses. So bear with me, if it gets a bit too technical. And feel free to stop at any time, right? If you want to ask a question, if you want to share your own experience, I think it would be quite interesting so that we make this more of a conversation as opposed to just myself, talking. Just out of curiosity, how many of you have ever invested in a startup? A couple people, okay. So you will more or less know what we are talking about today, and then I guess for others this might be new information, but you are in the right place to learn. So, as you know in karate, the hardest belt is the white belt because you need to start, right? And starting is the most difficult thing to do. Okay, enough jokes from me. That's a very big head of mine, but just maybe a short introduction of myself. I'm a general partner at First Pick, an early stage fund investing in pre-seed companies in the Baltics. I have been a VC for 7 years now. I joined Startup Wise Guys previously as an investment manager in 2019. And since then, I have been investing in startups and together with the team, we have backed 95 companies today. So quite a lot of investments, some successful, some less successful, a lot of mistakes, a lot of hard learnings, but everything that you will hear today is based on our experience of working with early stage companies in the Baltics. So everything, is not theoretical, it's practical. And before that, I worked in Civita, management consulting firm. You have it in Latvia here as well. I was part of a team that worked with tech and innovation. So overall, I'm in tech for more than 10 years and 7 years as an investor. My contact details as well, if you feel like reaching out after this to discuss, deals, investment possibilities, feel free to do so. A little bit about First Pick. Just out of curiosity, has anyone heard First Pick before? Some people. Okay, nice, good. We need to do more marketing in Latvia then for sure. Very briefly, First Pick is a first check investor for Baltic founders. What it means is that usually we are the first institutional capital for early stage startups. So we invest as early as angels, and quite often we do co-investments together with angels or other smaller VC funds. We are a pan-Baltic fund, and we focus very much on the founding teams. So we look for exceptional talent and exceptional founders. This is our team, 4 GPs, myself, Jone, Dimitri, and Marius. So like I said, together we have done almost 100 investments. We have 5 exits and overall have invested 20 million into startups throughout the 7 years. So quite a big portfolio and a lot of expertise. We focus on the Baltics and we see almost every deal that is happening here. So for example, in 2025, we have engaged with 90% of all companies that have raised capital. So we pretty much see every company. Some deals we win, sometimes we don't, but at least we have the opportunity to interact with them and to make our own opinion. So have quite a broad exposure. And with the latest fund, with First Pick Fund 1, we have invested in 45 companies. Out of them, a couple are in Latvia. Handwave, maybe you've heard about them. Swatsy, Birdie Chat by Roland Smesters. So a couple of names that we are very excited about, and we see a lot of good companies here. Majority of the portfolio is Lithuanian, and a couple of Estonian startups as well. And the fund is backed by a lot of strong investors. We have some of the Lithuanian unicorn founders that have backed us, from Tesonet, from Vinted, from Kilo Health. We do have a couple of funds like Speed Investor Blackbird, and also very happy to have Latban as our LP, who did a syndicate investment into Firstbook. So thanks for your support. We really appreciate it. So we are now also fundraising for our second fund. We are raising an 18 million euro fund. So if this is something that you would like to learn more about, I'm also happy to speak during the networking part. So a short advertising from myself. Okay, and this is it. Let's move on into the workshop of today. Now you have the context, you know who I am, and you know why I will be talking about this very important but very technical topic. So we'll start with Baltic funding landscape. Emils and I thought that it might be interesting for you to see some numbers, what is happening in the Baltics, how much companies are raising, what are the dominant verticals. So I'll briefly cover that, and then we'll go into 3 subtopics: term sheets, investment agreements, and some of the typical mistakes that angel investors make when investing in startups. So let's kick it off with the Baltic funding landscape. Every year we do a report on the Baltic startup funding scene, and we collect data by calling founders and asking them for a lot of sensitive information. So we call them, they say like, we know that you raised money, what was the valuation, what was your revenue at the time of fundraising, can you give us all the detail in confidence that we will not share it with anyone else, and we'll present the aggregate numbers. So we say that we have the best coverage of the deals because of that, and no other platform like Dealroom or PitchBook is able to collect such data. So everything that you will see here is actually coming from bottom up from the market. So if we look at Lithuania, here are some of the key numbers of 2025. There have been 11 exits, which is the record year. And, there was 77 million attracted in pre-seed capital by Lithuanian companies, and overall startups in Lithuania raised 240 million almost. In Latvia, the highlights are that 3 new funds have been opened. So you already met Maria from Outlast, but also Bad Ideas Fund and Build It. And this brought 60 million of fresh capital into the market. And overall, startups have raised 76 million. So Latvia is a bit behind in terms of total funding raised, but we hope that the launch of the new funds will accelerate it, and that we will see better numbers in the upcoming years. Estonian companies are leading in the Baltics, so they have raised most capital out of the 3 Baltic states, almost 300 million. So more than half of all funding in the Baltics is going to Estonian companies. And it has always been historically like that because their startup ecosystem is the most mature. 73% of all Series A rounds also happen in Estonia, so meaning that both early stage but later stage companies as well raise a lot of capital, and pre-seed investments grew by 2x. So pretty strong dynamic, suggesting that we will see more capital flowing into Estonia as well because the pipeline is healthy. If we look at the total numbers year over year, you can see that in 2021 and 2022, there was this massive spike. And this was a global trend that we have seen in startups everywhere. People call it the super cycle in startup investing because just a lot of capital went in. And then because of COVID, things kind of slowed down and there was a bit of a drop or normalization, because if you look at it, I mean, the numbers are quite stable afterwards. But what is interesting to observe is that the number of rounds have decreased, whereas the capital is somewhat stable or almost increasing a little bit. And this suggests that there is capital concentration in the market, that companies are raising fewer but larger rounds, and that startups are becoming more expensive as well. So if, in 2019, maybe startups at the pre-seed stage raised about 100,000. Today, the average pre-seed investment is closer to 500,000. So for you as angel investors, it's important to understand that numbers are going up, and therefore potentially your investments have to go up as well. If we look at some of the top verticals, you see that the picture is very colorful. There are different verticals dominating in different years. And I often get this question from foreign investors, what Baltics are known for? What are some of the industries that you specialize in? So the reality is there are no industries that we specialize in. There are different companies that are good in different fields. And 2025, of course, was the year of AI. You can see that both in terms of total deals and the capital raised, AI is dominating. We expect that to remain in this year too. And other fields that are receiving a lot of attention currently are defense. We see a lot of both defense companies and defense investors. Yes?
What is your definition of AI in this case? What does it mean?
Yeah, that's a very good question. This is quite broad. So it would be, any software heavily focusing their product with AI functionality. So it can be a logistics startup building an AI-enabled procurement solution, and we would probably categorize it as an AI company.
So fintech will not use AI in this case?
I mean, they do, but I guess this is about the core value proposition, what is, in essence, the core? Like if we are talking about peer-to-peer lending, we would put it into fintech. But the lines are blurred, and this is a fair point. It's difficult to differentiate sometimes. Yeah. But that's the hard part about crunching numbers and making statistics. Anyways, I think you can feel it. You can really see, how much information about this topic and this vertical is out there, and that people really feel like, okay, this is a game-changing technology and they want to invest in it. A little bit more technical data, but we also did an overview of the valuations and round sizes. So I think what is important for you to note is that the trend is going up. Round sizes are increasing and valuations are increasing as well. If the median valuation in 2019 was €500,000, it was about 2 million euros. Today, it is closer to 3.54 million, right? So companies are becoming more expensive. We are still below Scandinavia. In the Nordics, the median pre-seed round is 1.5 million. So companies here are still cheaper compared to the Nordics or Western Europe, but they are becoming expensive and the gap is narrowing. So you just have to keep it in mind. At the seed stage, the overall trend is the same, but it is more stable. The increase isn't as big as it is in pre-seed. So there, we see less volatility as opposed to pre-seed companies.
Is that right, that Lithuanian seed rounds are lower than Latvian?
In terms of valuation, the thing is that the data set is quite limited. So although we present this data, it's driven by, maybe 10, 15 deals. So then when you look at it, it skews the data a little bit. But that was, the reality this year, that Latvian startups raised at higher valuations than Lithuanian companies did. Yeah. And these are some of the highest rounds. Just for your curiosity, some of the companies at different stages in different countries that have raised most capital. And you can see that these are outliers. If median pre-seed round in the Baltics is €500,000, then those companies that raise the largest pre-seed rounds, they're able to raise 1.5, 3 million sometimes even. At the seed stage as well, those are like really big rounds. 7 million seed is, very, very, very solid. And then Series A+, so these are growth rounds and maybe the ones that you have seen in the news if you are following some of the tech and startup news. So Cast AI, a Lithuanian company that became a unicorn this year. Aerons in Latvia, of course, amazing company. And Pactum in Estonia. And the investors that were leading the rounds as well. So here are the most active investors in the Baltics. You can see that Latban is also one of the most active investors at the pre-seed stage. And also we included a few foreign funds that are quite active in the region and have done a couple of deals. But overall, these are the names that you would see in the news and that are pretty active. What is interesting is that 43% of deals had at least one foreign investor participating in it. So a lot of foreign capital is flocking to the Baltics. And in 2020, the number was closer to 20%. So there's almost double the amount of foreign capital coming into Baltic startups. And this is a good and healthy sign. Most of this capital is typically going into later stage companies, Series A+, but we see some foreign funds investing in early stages as well. So here are some of the top names, really tier one, like extremely well-known, very good reputation. Those funds are investing in Baltic companies, and this is a healthy sign for everyone. So like Index Ventures, Early Burn, Dawn Capital, these are top brands, and for us it's great that they are here and they want to invest more. And these are some of the funds that have raised capital last year. So like I mentioned, the 3 Latvian funds, Lithuanian, Estonian, international funds. So overall bringing about 300 million of dry powder into the Baltics for the upcoming 3-4 years. And the last bit on the exits, so 2025 was a great year for exits. The number is inflated mostly because of Lithuanian companies. You can see that there was a massive surge, but there also have been exits in Latvia. So probably you've seen TestDev Lab, super great exit. Everyone is very happy about them. And actually later I learned that there have been 2 more exits in Latvia as well. So we need to update the slides, update the information. But yeah, some bigger acquisitions like Ready Player Me in Estonia that was acquired by Netflix, or Trafi in Lithuania that was acquired by a German company. So really a lot of good acquisitions, and of course this brings back liquidity to the market, brings back liquidity to the investors, and Jānis will share later how this is done. Right. Okay, super. So that's it about the numbers. Anything you would like to discuss there? Something surprised you? No? Okay. Numbers are just numbers, right? It's statistics until it becomes someone's story. Great. So then we can take a look at term sheets. So this is how a typical investment process looks like. And this can take anywhere from a week to 6 months, 9 months, 12 months, depending on the stage. The larger the investment, the longer typically the process takes. But normally we start, with pitching. You meet the founders, you learn about them, you do due diligence, you negotiate, and once you make a decision, a term sheet is issued. So term sheet is sort of, your expression of interest to invest into the company. After that, you normally have a couple of things going in parallel. Maybe you start some legal due diligence to, check if the company is correct, if there are no problems, no issues. And you draft the investment agreement, which is the main contract between the investor and the startup. Next to the investment agreement, you typically have 2 more documents. The shareholders agreement that basically outlines the rules of how the shareholders will make decisions and how they will interact. And the share subscription agreement, where you just buy the shares as an investor from the company. So very technical document. After all of this is done, the funds are transferred, the founders pop the champagne, and continue working. So it can be quite a lengthy process, and it involves a lot of documentation. I think if you're investing as an angel alone, then it's important for you to know these steps very well. If you're investing through a syndicate, then typically you trust the syndicate representative to take care of a lot of this for you, and you don't have to worry that much about digging into the legals. So let's start from the beginning, the term sheet. So the term sheet is, like I said, your expression of interest. It is a non-binding document that is signed between the startup and the investor that expresses the main terms of the investment. How much money I'm investing, at what valuation, what are some of the main clauses that we want to agree about, So, it's sort of like a few pages, a summary of the whole investment, right? The main terms. It's important that the term sheet is a legally non-binding document, so everyone can back out of the investment if they feel like something is going wrong. And typically it's also valid for a specified period. So it's not, if you sign it, maybe it's valid for a month or for a couple of months or a couple of weeks. And if you don't sign the investment agreement, you have the right also not to extend the term sheet. So it's quite important to know this because things can fall apart. Maybe during the legal due diligence, you don't like something that you see, you decide you don't want to invest, and you are not contractually bounded to do so.
Maybe a quick question.
Yeah.
Maybe based on your first big experience, like percentage-wise, how many deals drop out from term sheet to up until investment agreement?
Normally, very few, very few. There have been cases where we decided to back away, and there have been cases where the founders decided to back out. But maybe like 1 out of 20. Usually when you sign the term sheet, you are quite solid that you want this deal to happen. Yes.
The question, you said also the founders can back up this, yeah? So
Yeah.
of uncertainty, you do the diligence, invest your effort, money, time, and they say, well, I don't want you anymore, I change my mind.
It can happen. It can happen. We had I think like one maybe case when it happened. The founders decided, we changed our mind, we don't want venture capital anymore. We will do a lifestyle business instead.
Is there any clauses protecting us investors that if you decide to step out, then something happens?
Theoretically, you can put in, that some legal costs, if you're putting in some legal costs, like the founders are contractually bounded to cover them. But those scenarios are very rare. They can happen, of course, but they're quite rare. I think there was
more like gentleman's agreement.
Yes, exactly. I think there was another question, no? Yes?
I have a new question.
Yeah.
How would you classify? Some startups are talking about such term as soft commitment. That some fund gave a soft commitment. Is it normal term, or if it is, then where would you classify it on this line?
Yeah. This is a very good question. So there can be a couple of scenarios here. The founder can be bluffing. That's possible. So then
You can ask the fund.
you can ask the fund. Yeah, you can if you know, and if the founders tell you, you can always ask the fund. Another thing is that the fund gave a soft commitment and they are really serious about investing, but they want a lead investor. So for example, someone is raising 3 million and First Pick wants to invest. We cannot lead such a round, it's too big for us. Our appetite is to invest up to 500,000. And we would want a strong lead investor to come in and to put in 2 million, to do all the paperwork and everything. But we really like the founders. So then we could say, yes, we give a soft commitment to invest if you find the lead investor. So that's real, Then I guess what you could do is ask the founder, can you introduce me to the fund so that I learn if they are serious about the soft commitment? What can also happen is that the fund is neutral. They kind of like the team, but they're not ready to commit yet. And so they wait for someone else to show the signal.
So this term would classify below term sheet.
Yes.
What do you think of founders who, sometimes when you meet these startups, after a few weeks, they report back to you saying that, hey, we received a term sheet from this fund for 400,000, and they don't reveal the name of it. They don't want to make the intro. How do you take these, situations? How do you approach them as well?
This can also happen. And there it depends. If there is a term sheet for the whole round, you might have to bid against it without knowing the details. If you have a good relationship with the founder, they might say that, we have a term sheet from this fund or a fund under certain conditions. can you give better conditions because we like you? And then you need to bid and you need to trust your gut whether it's true or not. But sometimes if you're joining as a co-investor, then I think they should reveal the details. So again, it depends. We have been in all the different scenarios where we tried to outbid, where we tried to co-invest. So
Have you had situations where you were outbidding nothing? Basically, they were bluffing that they have something.
No. I think somehow like we always figured out who it potentially is, who is on the other side. You would learn from other funds, like you would collect some intel, so you would know. But yeah, there was always a risk that they're bluffing. But I think you can sense it. You can. The worst thing that can happen is, you talk to a founder, they're fundraising, and I always ask at the end of the call, who else are you speaking to? And then they say, oh, I'm speaking with them, and Creandum, and Early Bird, and Lakes, like all the big brands. But I know all of them. And then I text them on WhatsApp, and they're like, no, I haven't heard about them, but can you introduce me? So this is a red flag. Then for me, it's a no-go, because then clearly, they're bluffing too much. So you need to stress test some things. All right, so coming back to this, the term sheet will depend on the type of investment that you are doing. And there are two main types of investments that you can do in startups. One is equity investment, where you buy shares for your investment in the company. The other is convertible loan, note, bond, depends on the country, how is it called. But there you are lending the money in exchange for future shares. So you don't become a shareholder immediately, but at some point in future time, you would become the shareholder. You are obliged to become one. So based on the agreement, the term sheet will have different information. If it is an equity investment, then you will see the investment amount, the valuation of the company, and the equity stake that is received for that investment. So, simple division. If it is a convertible loan, then there are more details because it's a loan, right? So you need to decide on the interest rate, the maturity date when the loan will have to convert. You need to decide if there is a discount on the future valuation because you are taking this risk now. And what is the valuation cap? So at what maximum valuation you would convert. So there's slightly more details that need to be included in the term sheet. And qualified financing is basically if the company raises, let's say, 1 million, then you automatically convert without waiting for the maturity date.
Is it often a surprise for the startup founders that this is a loan, not investment?
No, I think it's quite a standard document, so they know what it is. It's just that it has some nuances because you need to differently, like the accountant needs to understand how to put it on the balance sheet correctly.
Do you have data on how many of these instruments are used in the Baltics?
We used to collect it, but I don't have it in hand, so I don't want to misguide you. Typically, we would always go for equity investment if we can agree on the valuation, because then we have all the documents ready, everything is clear, we become shareholders, we sign shareholders agreement. So legally, this is the best option. For convertible loan, we would sign it if we cannot agree on the valuation. So a company comes to us, we say, your valuation is 1 million. They say, no, our valuation is 5 million. You negotiate, and you still cannot agree. And then you say, okay, let's invest through a convertible loan. We will put a valuation floor at 1 million, and we will put a valuation cap at 5 million that you want. And if you are able to raise the next round at a valuation that is 5 million or higher, then we convert on your terms. If you're not able to raise and the maturity date comes, we convert at the lower valuation. So this way, you incentivize the founders to really go and raise the next round of funding. Otherwise, they will convert at a lower valuation and give away more shares. And for you, as an investor, typically that's a good thing because it means they have capital to continue building the company. But of course, like 1 and 5 is a very big gap. Usually it's like, I don't know, 2 and 3 million, something, closer. So the risk is more balanced. But these are specifics. So I briefly touched upon this. I will not go into too much detail here, but again, just to remind you, equity investment includes the investment, which is your contribution, the valuation, and the valuation can be pre-money or post-money. Pre-money means the valuation before the investment is added on top of it. So post-money, you just take the valuation and you sum it with the investment. And the last bit is equity stake or your own ownership proportion in the company. So based on the number of based on your investment, you divide it by post-money valuation and you get your shareholding in the company. Pretty simple. Convertible loan, again, has more of these elements. So we start with a contribution, then we have the valuation cap, which is the highest valuation at which your investment would convert. We have the discount, and this is a reduction of share price upon conversion. Now, the valuation cap and discount, I think sometimes they're confused and people don't fully understand how it works. And they think, okay, I will apply the discount to the cap, but it doesn't work like that. Typically, it's the lower of. It's either the lower discount or the lower valuation cap. You have to choose between the two. You cannot apply both of them. And then other elements, like with a typical loan, you have an interest rate, sorry about that, interest rate, which is paid on the loan. So the founders, you actually sum up the loan and get some interest on it, which is later converted into shares, typically. There is the maturity date and the qualified financing. So sorry, a bit of mistakes on this slide. Maturity date is when basically the conversion needs to happen, and qualified financing is a round that the company needs to raise for the conversion to happen automatically. Okay, going into even deeper into some specific clauses. So let's look at protective provisions. These are some of the most important things that you want to have in the investment agreements and in the term sheet to protect you as an investor. So number one is liquidation preference. And liquidation preference sounds fancy, but what it means is what is the order of payout in case of liquidation of the company. If in case there is an exit, in case someone sells it, in case someone buys the shares through a secondary activity, who gets paid out first? And this is important because if you are typically founders and angels are at the bottom of the list, so you want to make sure that the liquidation preference is good for you and that later stage funds don't have some crazy liquidation preferences. Then there is anti-dilution. So it is protection against future dilution. This is applied in case startups raise at lower valuation in the future, down rounds. There's no anti-dilution for up rounds. If the company is raising at higher valuation, like you get diluted, that's just the way it is. But if there are down rounds, then you have some protections. And the last thing is board composition. In later stage companies, especially, investors require for a board to be established. And typically investors have one representative in the board. So it's not, if you invest through a syndicate, you will not have to be on the board. Typically someone will be appointed to represent your interests in the board. Also, there are founder commitments that are important for investors. One is vesting schedules, meaning that founders will not receive all of their shares immediately, but those will be vested over time. So typically it's 4 years, and this requires the founders to actually commit to the business, So they are incentivized to stay in it and not just, raise the capital and leave the company and have 20% of in the cap table, which is then dead equity. And there are also transfer restrictions, which basically prevent founders from selling their shares in the early stages of company development. So again, to make sure that you have founders that are committed, that are incentivized with proper equity packages. So what does a term sheet look like? I kind of copied a couple of images from our term sheet. So, very simple document, like a table that outlines the main terms. So here you can see this is for a convertible loan instrument, what is the interest rate, maturity date, all the things that we spoke about. They're just listed, plain simple, so that there's no wrong interpretation. It's fairly straightforward. And these are some of the other clauses that are also included in the term sheet. So simple document, I think you can read it yourself. You can put it into ChatGPT, not legal advice. Or you can hire a lawyer, of course, to help you go through this. Okay, so what's next? You sign the term sheet, so the next steps are legal due diligence and negotiating and signing of the agreement. So legal due diligence, usually it is outsourced to lawyers, and they just run through the company to see this, they check that everything is in place. And negotiations are something that the investors are doing. So investment agreements. We spoke about a few things, so I will just run through this quickly, but typically we have convertible notes, safes, and equity investment agreements. So convertible loan works very well when you don't have, for early stage funding, for bridge financing, when it's unclear what the valuation of the company is and you want to have more room and more flexibility. Safes are not very typical in the Baltics because they're not really adapted to European legal structures. There's no such thing as a safe that would be adapted to European law. So typically people go for convertible notes. It's an adaptation of the safe that is actually working in the European law. So here, please correct me if I'm wrong.
No, it's fine. Yeah,
Okay.
Which is
Good.
the safest?
And equity investments, I would say, are the safest because there you become a shareholder of the company right away. So there's very little room left for interpretation. You become a shareholder, you are on the registry, you sign a shareholders agreement, you agree on all the rules. So this is the safest. Of course, it takes the longest to negotiate as well because the paperwork is much larger. And yeah, it's like a lot of paperwork in general. If you do a convertible loan, you will have to do the paperwork just in the future. So it will need to happen anyways, right? You'll need to have the shareholders agreement one way or another. The thing is that, with the convertible loan, maybe you sign the loan, then the company raises the next round of funding, and the new investors will prepare the shareholders agreement, so maybe you can avoid it.
So what happens if they go bankrupt? And then is it like what kind of liabilities on founders? Personal guarantee?
If they go bankrupt, there are some liabilities on the founders typically, but only if they do something wrong, like if they commit some fraud or there are some serious issues intentionally doing harm for the business and they do not fix that in a specified period of time. But if the company simply goes out of business and they fail to find product market fit, then there's no liability. And it's the same, if it's a convertible loan or...
But I've seen some examples where, investors are providing some bridge financing or some loans, but I've seen examples where the founders are providing some personal guarantees, either it is their own valuables or something like that. But
they do provide some personal guarantees, but usually they are not if the business doesn't work. Usually it's for committing some serious breaches, and those liabilities are typically like maybe 10% of the total investment. So they're, you will not, if the company goes out of business, you will not ask them to, bring their Rolex and their car and and try to get money back from them in this way. I think in general, investing into startups is one of the riskiest investments that you can do because there is no guarantee. When you're investing, when you're lending money, there's typically some collateral. When you are investing in stocks, the chance of your money going to zero is quite low. with startups, it can go to zero. So you need to be prepared to lose everything. And that's very important. You might make a lot of money, you might be super successful, but you have to be ready to lose everything that you invest in startups. So it requires big risk tolerance, and therefore I would recommend to start with like a certain allocation in your personal portfolio that you are comfortable with allocating. Maybe 10%, maybe, I don't know, 15% if you want some risk. But it shouldn't be like all of your savings, all of your cash that you have. So not giving financial advice. Yeah.
In hierarchy, in insolvency hierarchy, the default, I mean, those convertible notes will be upper against equity, equity, general equity.
Could you repeat, please? I didn't hear the question.
So if the company goes bankrupt, as we just discussed, in insolvency hierarchy, who gets money first? So this loan, most likely this creditor is the first who gets, rather than equity investment. Or this convertible note doesn't proceed.
I don't want to comment because I'm not a tax expert and I don't know how exactly it is, but I think first it's shareholders are the last in the line.
So I mean, in terms of risk, you will get here. I mean, the first, in comparison with pure equity investment, direct investment. While still in convertible note loan, like 4 years or whatever it takes to mature.
I cannot comment on this. I think in practice it never happens that you would get the money back as an investor from if you put in a convertible loan. But
it's like, for example, there is some development is going on, right? Some property or intellectual property or software, whatever. You can insolvency administrator would sell that. There is some value.
I understand. Yeah.
Those convertible notes owner or
I understand what you're asking, but I cannot comment. I don't know, maybe Yanis knows better.
I think it depends on the jurisdiction. So basically, I think in Latvia, it's very low on the schedule. So you get trenched really low in the insolvency proceedings because it's basically just a debt in a sense. So any other would also come in front of it as well and it'd be pulled together and then will be divided for the specific debts that you need to cover. So it's as you say, it's not that typical that you actually get some return from those situations because there's just no capital to actually divide at the end of the insolvency proceedings most of the time.
Yeah, typically, you have some employees and a piece of software.
Some computers, maybe, some chairs, and
yeah, but there's hardly anything to sell to get the money back. That's the reality. Okay, so moving on. How much time do I have? 15 minutes?
15,
10? Okay,
10, 15. Yeah.
Good. So with the convertible loan, some benefits and downsides. The benefits are that it's fairly simple and you can draft the agreement fast. You don't need the shareholders agreement. It's better, and if you need to close the deal fast, especially if it's a bridge financing, then typically the founders need the money quite fast. It's nice that you also have the interest payment, so sometimes you put it on top and you get extra shares. It's mostly suitable. With the interest payments, you get extra shares, but it increases dilution for the founders. So it's a bit tricky. It's suitable for early stage companies that need quick fixing or for bridge financing. With the SAVE, I still want to touch upon it because I think if you will start angel investing, you will see it. For example, you might have a Latvian founding team with a Delaware company, and then you would be investing in the Delaware entity, and they might invest through a SAFE. So it would match the US jurisdiction, and therefore it would still be, everything would be correct. So with the SAFE, the biggest benefit is that it's really, really simple, a very simple, short document, quite standardized, and it makes negotiations very fast. Typically, they don't have interest or repayment obligations as opposed to this convertible note, but investors have a lot of risk, in my opinion, because the documents are fairly short. They don't include a lot of the clauses. You talk about only very basic investor protection, and personally we don't like them. But that's just personal opinion, right? It's usually suitable for early stage, like inception and pre-seed startups. It started in Silicon Valley as a way for people to invest quickly, for the angel investors to fast put the money into founders that they liked. And those investors, they thought, okay, if the company is successful, they will raise the next round, and then, we will convert and have all the documentation. If they are not successful, we will just write it off. And it means they're not successful, and therefore we don't care to overinvest in the paperwork and all the legals. That's the way it is. And with the equity, like I said, I think legally it's the best document because you have very clear ownership, very clear rules, very clear agreements with the founders, but it's a longer and more difficult process. So it just takes time, and the negotiations are longer. It's really suitable for later stage companies. So I think everything seed plus, you wouldn't see convertible loans unless it's a bridge round. So there it always is an equity investment. And and usually startups choose it, when they want to raise capital from bigger funds for strategic partnerships. So just very briefly, after the investment agreements, we have the shareholders agreement. I will not go through everything, but basically it explains all the rules of how the shareholders will function, what are the controls that investors will have in the company, because typically you join as a minority investor, but you want to have certain provisions to prevent the founders from making decisions on selling the company, issuing new shares, increasing their salaries, sometimes declaring insolvency, paying dividends, right? So you want to have protections as an investor, and typically this is where all of those protections are included. So some of the critical clauses are pro rata rights, so your ability to invest in future rounds to maintain your ownership, the liquidation preference, exit rights, anti-dilution provisions. So really technical things, but luckily today with the help of AI, you can learn about them in detail when the time comes. So my advice, when you are participating in and investing in companies, this is the longest document, but it's really the most important because it will define the rules of governance for future. And then you have the share purchase agreement, which is like super technical document. You just buy the shares, you transfer the money, and you sign the agreement that you actually bought those shares, but you need to know that it exists. Good, so we can spend like a couple more minutes on some of the typical mistakes, and maybe if you have some more questions, we can look at them. So some of the mistakes in the due diligence process. I would say one of them is investing with excitement instead of judgment. So, try to really separate emotional attachment from critical evaluation of the potential investment case. You might get very excited about the founders, about the industry. Maybe you worked in it before. Maybe it makes sense for you. But try to really also assess this as an investment, as you would assess investing in a stock or whatever. So really do the diligence, look at some comparable deals, some real signals. Try to learn more about the company. So I think that would be my number one in due diligence. Number two is skipping some of the hard questions. And I think majority of your due diligence in the early stage should be on the team because they will have a product, maybe some early traction, but the team is the most valuable asset. So what you can do is try to collect references on the people, try to call their previous employees or previous teammates. Try maybe to ask some hard questions, For example, you can always ask, what is your future vision? At what price you would sell this company, for example. And that also gives you a signal, whether you can make money out of it. Because if they are ready to sell for 1 million, probably you as an investor will not make money. So, try to ask some hard questions, test the founders, build a relationship with them. And of course, another mistake is not reading the rule book. So the SHA, again, just a reminder, read it carefully because this defines all the rules and your protections. Now, you can also be making some mistakes with the founders and the co-investors. One of them is, being a demand or an helpful investor. So as an angel investor, you need to understand that this is a long-term game, and probably the companies will not break even in a year or two, or even 3, or even 5 sometimes, and that the returns will not come in year 2 or year 3 or year 4. They might come in year 5, year 6, year 7. So as an angel, it's important to be helpful, to try and connect them to your network, bring potential clients, see where you can support them, instead of being harmful and asking for payout very early on. So I think the overall sentiment now is getting better, but back in the day, we had some very hardcore angels that were investing and hoping to get their money back next year. So now this is changing. And of course, don't be a bottleneck. Once you become a shareholder in the company, you will need to sign a lot of documentation. If it's done through a syndicate, then of course the syndicate will take care of this for you. But otherwise, you might need to sign every single time the founders issue new shares, they give out ESOP, they want to increase the salary of the CEO, they want to open a legal entity in a new market that they are entering. So you will have to put a lot of signatures. And I think as an angel, you never want to be the bottleneck, because you're on holidays or whatever, but actually be responsive and help the founders when they need to make decisions fast. Mistakes with money that you might make as an angel investor. Sometimes you think lower valuation is better because cheaper is better. That can be true, but you need to look at all the different clauses as well. For example, the liquidation preference that defines, who gets the money back first. So you might have in the future some investors that put in like crazy liquidation preferences, so you want to avoid this. Also, sometimes you might think, okay, I can get 10% in this cheap company, so I will have better chances of making the money back. But you might have a chance to invest at 1% in a company that becomes a unicorn, and you probably want to be in the unicorn. So don't let the valuation be your main judgment when making investment decisions, because it's more important to find the right company than to find the cheap company. Unless, I don't know, you're Warren Buffett. Another thing is about putting all your money into one startup. You allocate maybe, 100,000 that you want to invest in startups, and then you put all of it into a single deal, and the company flops. And that's it. So as in any investment, you need to diversify. And ideally, you should invest in at least 10 to 15 companies in order to have good and well-diversified portfolio, not to put all your eggs into one basket. So the easiest way to do it is to participate in a lot of syndicates, because then you can allocate smaller proportions into more deals while getting a proper allocation in the startup. Because a lot of founders, they will not take 5,000, they want maybe like 50K, 100K. So then pooling it through a syndicate is actually better for you. And of course, not understanding how you exit. So when you look at the companies, and we will be speaking about this now, which is super exciting, you need to think, what could be the potential exit opportunity? Could they potentially be acquired by competitors? Could they potentially sell their technology? What could be, just in theory, what could be a plausible exit? So it makes sense to try and brainstorm it, and this is an activity that you can do together with the founders. Of course, in the early stage, it can be hard to tell, but at least you might have some idea of how to potentially exit it. And this is it. Questions? We have like 5 minutes for questions.
Yeah, we can spend 5 minutes.
Okay. Thanks. Nice.
Yeah, questions.
So it can be related to this, or it can be anything.
When was this sort of big investment you showed on slide?
October maybe? November? I don't remember for sure.
Yeah, it's how to use
Yeah,
plus and minus.
I think so. Yeah. Yes.
But big topic, how do you do valuations of equity?
Yeah, how do we do valuations? I think a couple of things. Usually when founders come to us, you cannot apply any like multiple on valuation because their traction is so low, it's impossible to put it like as a multiple. In later stages, like Series A plus, then usually it is driven by multiple on valuation. You know, you take the revenue and you apply some industry standard multiples, and this is how you determine the valuation. At pre-seed and seed, you do triangulation. You look first at the market numbers that I showed in the beginning. This is why we collect the data, because we want to see at what valuations companies are raising. Second thing is you want to have a healthy round structure. So let's say if a company is raising 200,000 as their first round, you as an investor wouldn't want them to give away more than 15, maybe 20% tops of the equity. So then you check whether this is, you know, so that would be like, what would be the math if they give away like 20% for 100K or, you know, 20% for 200K, what would be the valuation? And you check if that makes sense for their stage, for based on the market metrics, and basically just do the math. The third thing is that we as an investor, we see a lot of different teams and we know which teams are excellent, which teams are worth, you know, the top quartile or even higher, and those are usually exited founders, successful founders with strong track record, building very interesting businesses, and which founders are yet to be proven. And those are usually at the median or below median valuation because there's more risk associated with the founding team or maybe with the business. Because if you see that this can be a business that potentially grows into, I don't know, a 10 million euro company, then the valuation you want to apply is lower. But if you see a business that you believe can grow into a unicorn, then you can afford a higher valuation in the beginning. So there's a bit of magic there. Yeah, there is no simple rule that you can apply.
What are the biggest mistakes?
In terms of valuation,
Finger
personally,
in the sky, and that's it.
no, personally, I think we lost a couple of deals because we thought that the valuation is too high and then we regretted it. So my mistake is, yeah, not following the instinct when the investment opportunity is good. Yeah, like we actually, in 2019 or 2020, we had an opportunity to invest into Payhawk.
Okay.
And
It's a Bulgarian company, right?
yeah, it's a fintech,
Yeah.
massive company now. I don't even know what's their valuation today, and I don't
I
want to
think
look.
around 5 billion, something
Yeah,
like that.
and they wanted like a 3 million, and we said no, 2 million. And we said no, we cannot afford to invest at 3 million. And today I regret it, yeah. It could have been a very, very good investment.
FOMO.
No, it wasn't very straightforward because they were building like a company that, you know, there were a lot of competitors. It seemed like it's not gonna really kick off, but it did. So personally, I think, yeah, that's the tricky bit.
But if it's too big for your portfolio, single investment, then you have
No, of course. I mean, you know, you cannot go crazy. Like if someone comes to me and they are raising at 20 million valuation, probably I wouldn't invest because the equity that I would get in the company would be super low. So I think you need to still apply like some logic into what is the minimum ownership that I am comfortable with. And for us, like if it's anything below like 3%, we wouldn't do it because you just cannot return the money unless it's like a massive outcome. But I'm speaking about those cases where, you know, it's like 2 versus 4. It seems like such a big difference, but in hindsight with Payhawk, it isn't.
You briefly mentioned the topic about startup jurisdictions, which is, I think, also a relevant topic in Baltics, because when some later stage investors come, especially foreign ones, they request you to register a different jurisdiction, right? We've seen with some of our portfolio companies, they say that Latvian jurisdiction company isn't suitable for them, so they ask to, I don't know, go to Tallinn or register in Estonia or register in US.
It can happen. I think it depends. It depends. Some investors might ask to relocate, like to have a US HQ. If it's a US investor investing, I think always they will ask this. In the UK as well. I think German investors probably want it, but it seemed to be becoming less common. But I don't know.
From time to time,
It-
still appears.
It does happen, but it also depends on the company's strategy. Like if they want to enter those markets, if they feel like they need a legal entity there, it can happen, yeah.
Other questions?
Yeah. So for valuation again, do you happen to use this free cash flow?
No, there is no free cash flow. I mean, no, you know, we are the first investor usually. So founders come to us. It's usually 3 to 5 people with an MVP, with 0 revenue or some revenue, maybe a little bit, maybe like 1,000 per month. There's nothing, there, you know, there are no metrics. So yeah, no methodology at this stage, at least. In later stages, people typically apply multiples. So there are some standard multiples, let's say B2B SaaS company multiples. What is top quartile, what is median, what is bottom quartile? Based on the growth, based on the different metrics.
That's going to change a lot.
And this changes. Exactly. And those change. They every year they can, you know, vary. But this is how people typically evaluate. Even I know that even in the situations where someone is acquiring like a Series A company, they would still apply multiples typically. Yeah.
All right. Thank you very
Cool.
much.
Well, I'll stay here so we can chat. Yeah. And